Welcome back. It's been about 10 or 11 days since the last recording. I was overseas. I had an incredible experience overseas. What a great time, a great sort of vacation for myself. Again, I was still working, of course, throughout most of my time there, but a great 10 days to kind of ground myself, experience different culture, and kind of reflect on some things at Benmore as we go into Q2. That being said, on the docket today, I have something that I'm noticing in software services. I wrote about this in my book. I'll talk about the Claude Code security update and how we won't plan on utilizing that on Benmore, and then kind of an outlook of Q3 for Benmore here. Q2 for Benmore here. So, first and foremost, one thing that I've noticed is a big short sort of phenomenon going on in software services, and we're seeing it with a lot of our clients. There's a scene in The Big Short where Mark Baum goes to the rating agencies, and of course, like the background. If you haven't seen The Big Short, I recommend watching it. But the background is essentially it's a group of individual scattered investors who found out that the 2008 housing market was a complete bubble and decided to short it, which was very unpopular at the time. And they made these short positions years in advance of the collapse, and they came out with billions of dollars and all became very wealthy. But it's a story of how they went through their investigative process to come to terms with essentially understanding that there's a bubble, and to short it. Now, one of the key parts of that was one of the characters, Mark Baum. He runs a hedge fund under, I want to say, Goldman Sachs or Morgan Stanley at the time. But he's going through his investigative process in terms of essentially figuring out why these mortgages, why people are defaulting on them, and why they're getting rated so risk averse by the credit agencies that rate these financial products and say, no, there's a low chance that there's risks associated with this, essentially meaning that people are going to pay the mortgage to a high degree of certainty. So he goes to the rating agencies and he asks, the default rates are super high on these mortgage tranches, these financial products where essentially they'll pull together thousands of mortgages across residential American households and put them together in one big product, because it's like one mortgage. A lender may make it's a $400,000 mortgage. Over the course of 30 years they may make $400,000. Now that's a ton of money, but to a massive bank that's breadcrumbs. But if you put 1,000 of them together, well, now you're talking in the hundreds of millions of dollars in sort of long-term return on investment. And the consensus was, well, everyone pays back their mortgage. Who doesn't pay their house? And if we put 1,000 of these together, it doesn't de-risk it. Just because everyone pays back their home loans, and we can put together 1,000,000 of these and it doesn't de-risk it. But the default rates were getting super high. People weren't paying back their mortgages to, I think, a rate of 7 or 8%. And so Mark Baum, one of the hedge fund managers, is investigating this bubble. And he goes to the rating agencies who take a look at these thousands of mortgages that are aggregated together. And he goes and he asks the rating agency, the people who determine the risk for these financial products, and he goes, why are you still giving these AAA rated, which is the best rating? It's like, no one, these are extremely secure financial products. Why are you giving them such high ratings? And, the character goes on sort of spiel about, well, these are, financial models and whatnot, but he kind of breaks through the layer and he goes, the default rate. And, the lady, the character, she takes off her glasses. Great metaphor here. She's wearing blinded glasses because she just got eye surgery. So she's wearing sunglasses inside to kind of represent the blindness that the rating agencies has. She takes them off and she just goes, if we don't give them the AAA rating that the bank who owns the mortgage tranche, the product, wants, that bank will go right down the block to our competitor and get the rating that they want, the AAA rating that they want. Because these banks, they want these tranches to be rated extremely high so that they can sell them, so they can put them on their books as extremely secure financial products. But anyways, that point where it's, if we don't give it the rating that they want, they're going to go right down the block to their competitors. And that's something that we're seeing now in technical services, if I'm going to be honest, with AI, with firms that are essentially not consulting firms, they're essentially labor firms. If we don't give our clients the timeline and budget that they want, they can take their idea, go to AI, get gaslit by AI. It's getting better, but get gaslit by AI and get the budget and timeline that they want, and then take it to one of our competitors. That doesn't change the fact that these projects of ours do fundamentally take, against our rating, how long they're going to take and the level of complexity that they're going to take. It doesn't change that fact for our projects. So with that in mind, it's just kind of a sort of trend that I'm seeing emerge. I think the easiest way to sort of get around that is just to maintain our brand and reputation of truthfulness and honesty. But it's still quite an interesting phenomenon and quite an interesting analogy, I think, to this. There's a massive influx of mid-market SMBs and startup technical services projects, development projects, because of products like Lovable, because of AI coding. They'll get them 80% of the way there, but we're seeing a massive, probably in the realm of hundreds of millions of dollars, if not billions of dollars worth of this market opening up. But the problem is it's such a bubble, and a lot of dev firms are making so much money off of it that they're just saying whatever they want to say to get the project. And they'll build them and they'll build them and they'll build them for a couple months, and then they'll just say, well, we need more money, or the project's like not able to be complete. And to this point, I don't think that this is malicious, because we made this problem at Benmore before as well, like early on in our company about a year ago. It's tough to make those estimations, especially when you're grappling for money. Sometimes you gotta, just take a project for the sake of taking a project. But the one thing that we never do is we never overbill. We never ask for extra money. But yeah, absolutely, some of our projects have gone over timeline, and some of them have gotten to a point where they've gone so grossly over timeline that, it's eating into our bottom line. So it's kind of a kick the can down the road sort of methodology. Now, of course, at this point in Benmore, we fixed that. We've outlined our processes to nail down scope and stuff in a very truthful and honest way up front. We have the resources to do so, where we can turn down projects and just be like, well, if you don't like our rating, then find someone else who's going to fulfill your project. But this is what it is. But it's kind of an interesting sort of conundrum in the industry right now, and the only sort of thing that I can say is that we have got to a place of revenue and resource allocation where we don't have to do that. We don't have to scrape by and just close a deal for the sake of closing a deal. But it's tough. And so it's kind of a buyer beware sort of situation right now in the market, where, there's definitely smaller dev firms or just labor shops. They're called body shops, where they just throw bodies at the problem. And it also goes all the way up the line. I read a report that the big consulting firms can do this. They do it a little bit differently. They have the brand and reputation established, and they're dealing with F500s where the money's not even, the person who approves the project at let's just say Boeing to work with Accenture. It's not their money. It's a $10 million project. It's going to go 2 years. When I say it's not their money, it's not physically there, like in their bank account. It's just the company's money. Accenture has the brand name, and they can kind of do that there. They can kind of go, but they go at it a little bit differently. They McDonald's it, right? So they have the brand, and they're just looking for a brand to work with. And so they can kind of McDonald's their projects out. But I saw a report that many again, it's in my book, that many technical services projects, many technical services projects end up just completely going out of scope, completely going out of budget, and some of them end up just draining money out of the clients. And at the very least, what we do at Benmore is it's like, of course it's hard to estimate, especially when we're talking multi-month long projects, but we never overbill. And I'm happy that we're able to keep that sort of, culture here at Benmore where we just don't overbill, but it's just kind of a conundrum of the industry. Let's talk a little bit about this Claude Code security thing that just got dropped. So Claude Code just dropped a research preview version of Claude Code, which is specifically targeted to help with security. So a lot of vibe-coded apps have a plethora of security vulnerabilities, especially if you don't have the time to look through every single line of code. We have some methodology here at Benmore just to sort of circumvent that, where we work within natively secure frameworks like Django that come out of the box with a lot of security. But Claude Code, I think, realized this gap in the market and released a specific product to sort of tackle that. And I haven't used it. I'm going to apply for access as a company. But I'm interested to see how effective that is and really what the quality of that tool is. Because if it's just like a prompt where it's like, you're a security expert, you can do that in Claude Code anyways. It's needed. I will say it's needed for sure. And if it's effective, it's going to be awesome. Because then we can rapidly build products and then sort of retroactively make them secure with this separate tool. But I am a little bit tentative. I would like to look a little bit more into the implementation specifics of that tool to see if it's just Claude Code with like a prompt that just says you're a security expert. It's not going to do much. But if they built out specific tooling and functionality to work within specific frameworks, that's going to be awesome. My bet is if this hits and people start using it, the next thing that they're going to launch is something in relation to compliance, which is also huge. And then they're going to disrupt the startup space, Dell, Vanta, etc. if they release a specific Claude Code tool just for compliance as well. I would say that that's a natural next step of progression if they're sort of specializing their tools. You have a Claude Code for coding, then you have a Claude Code for security, and then you have a Claude Code for compliance. That would be my guess is what's coming up next. And then you'll have a DevOps Claude Code for deployment. And if that's the route that they're going, they're going to take over the market. And if it actually works, the moment that Anthropic IPOs, I'll be dumping half of my net worth into that company if these tools are effective. But yeah, I digress. I'm very interested to see and dig into the methodology of those tools. The last thing that I'll go over here is the outlook for Q2 at Benmore. So recently we've doubled our ad spend. I think we're bringing on a new AE. Our team size is growing rapidly and we aim to keep that momentum going into Q2. Our goal, end of year, is to be at the $1 million per month in run rate. So that means essentially we have a very decentralized book of business, which is good, which means we don't necessarily depend on one specific client, which is awesome for us as a firm. It allows us to make those tough decisions in terms of if someone's, being unrealistic about a timeline, we can just be like, well, we can't do it. But if we can get to $1 million a month, which is our target by the end of the year, that would be huge. That would be bootstrapped from 0 to 12 million ARR, annual run rate, not recurring, with a decentralized book of business and a scalable sales pipeline. I think that positions us very well going into next year to tackle those $50 to $100 million markers that we want to get to. I want to get there. I know we're going to get there. I'm super confident that we're going to get there. But this next quarter is going to be huge because we're making some risks on the marketing and sales side. We're upping spend again. And if this hits, I really want to get those 9 digits as fast as possible. From Bootstrap 2, come on. That's going to be huge for us. But that's our Q2 sort of outlook. Is our end goal at the end of the year is to be at 12 million ARR. That's $1 million a month. And in Q2, if we can get to the 600K or 800K, basically what I'm saying is we have just nailed down our processes on my side of the business. I wrote our manifesto. We have just promoted Arkish to be head of FDE. And I think things are falling into place on my side of the business. I think my side of the business is getting to a point where we can scale into the 9-figure mark with our current processes. Now, of course, other stuff is going to come up, but it's mainly going to be managerial processes. Our ground level structure is very established. Our process, our base level process of what an FDE should be doing to fulfill these processes, to fulfill these projects, is just really got cemented. So it's kind of a game now of just sales. And I'm very, very, very excited going into Q2 to see how sort of our cemented processes tally up against influx of sales. And if that holds next quarter, it's gonna be a bullet train. It's gonna be a bullet train, and potentially we'll talk about outside capital, but I don't really think that we need it. We want to keep our equity as long as possible. We want to stay private, but if this next quarter comes through for us, where our processes that I've recently just cemented on the FDE side holds up against an influx of sales, we're bullet training. And I'm very excited for that. So anyways, that is the February 21st update. I'll see you all tomorrow. Again, took a little bit of a hiatus, a much needed hiatus. And I'm excited to get back into it. So thanks.